Greetings from Costa Rica. My name is Matt Rosenstiel, and I'm live here in the office of Latitude 10, Costa Rica Rentals and Real Estate. Thank you very much for joining me. If you're on Facebook and watching the live broadcast, please give us a like. If you're on YouTube, please subscribe to my channel. I'd really appreciate it. Today, I haven't given any pre-warning of the broadcast because I got some information this morning about a new supercritical tax law that is passing here, or that is going to come into full effect in July here in Costa Rica. And I wanted to talk as soon as possible with my clients and create some information to use in understanding the new capital gains tax. Costa Rica has passed a new fiscal reform law that comes into effect, full effect on July 1st, 2019. And one of the features of this tax law is the capital gains tax. It's a significant move because previously Costa Rica did not have a capital gains tax, and that was one of the aspects that made investment exceptionally attractive here. But today we'll talk a lot about the taxes, nuts and bolts, give you an idea of how it will affect you if you're interested in investing in real estate here in Costa Rica. If you have any questions, either during the broadcast or afterwards, feel free to send me an email. I'm available at matt@cbtamarindo.com. Again, my name is Matt Rosenstiel. I moved to Costa Rica in 2008 as a U.S. Peace Corps volunteer, and I've been here pretty much ever since, and I work with Coldwell Banker Tamarindo Realty. Without further ado, let's look at the topics we are going to talk about today in addressing the capital gains tax subject. First of all, we'll look at sort of the broader context of Costa Rican taxes and the situation with the government. We'll talk about property values and records and where you can find the registered value of a property, how this is going to be calculated, etc. And finally, we'll go on to the nuts and bolts of the new capital gains tax, talk about percentages, what it means to you, and essentially go over the logistics of how this tax is being implemented. So to jump right in to our first topic here, in general, Costa Rica was one of many financial paradise countries to which investors were attracted for largely those tax benefits a long time ago. Over time, that has been changing. Costa Rica is no longer a Switzerland or a Panama or a Belize in terms of the attractiveness that the government has for outside investors in perhaps avoiding any taxes. And in fact, the government, what they're trying to do currently is boost sources of revenue through new taxes, just like virtually every government on the planet. Here, the Costa Rican government gives free health care to its citizens, free public education that reaches even the small rural areas, and a lot of other things that the government provides. And just like governments everywhere, they're realizing that they're going to have to generate more income in order to cover those expenses and the unpaid liabilities going forward. Costa Rica's debt to GDP ratio is currently at about 70%. You can't blame their entire situation just on the socialism or their socialist programs. The U.S. ratio is up at about 105%, I believe. But the government is in debt and starting to look at a long-term picture of how we can balance our financial picture. This financial reform law that comes into effect exactly on July 1st is one of the steps that they're taking to try and secure their long-term finances, continue providing universal free health care, good pensions, on and on to their citizenry. So this financial reform law is very hotly contested here in Costa Rica. Luckily, we're in a country where protests are democratic, absolutely. People just voicing their opinion, showing up in marches and that sort of thing. And there has been some outspoken criticism. Many people always want to see just the government reducing spending instead of boosting revenue. But in Costa Rica, they have passed this tax in order to boost their income. So let's look at property values and records in Costa Rica. If you've looked at real estate here or you're considering an investment, then you might have already heard that there is no centralized database, MLS, that is strictly maintained with all of the real estate transactions here in the country, like you would see in the US or Canada. However, what Costa Rica does have is a national registry of every single property in the country that has a title, or even the leased properties that are concessions from the government. This national registry does include information as to the value at which a property is taxed or assessed for tax purposes, and also it contains information as to the price at which that property was previously sold. It's important to note, because there has been no capital gains tax in the past, a lot of transactions here in Costa Rica, real estate sales, have been done in a manner which shields buyers and sellers from taxes initially. In other words, on a sale contract that is submitted to the National Registry, oftentimes both parties agree that okay, we're going to be sending these funds from the US bank account of the buyer to the Canadian bank account of the seller. The funds won't touch Costa Rica. Let's go ahead and say that we sold this property at half the value when we're submitting the sale document to the National Registry so that we can avoid taxes. That does save you taxes, or has previously saved you taxes on the initial sale, where the 1.5% transfer tax that happens at the moment of a purchase is obviously lower because you've got a lower declared value. Though, there's a problem that's created when, over time, lots and lots of transactions have been done either in that way or really sort of a circuitous manner that doesn't put the full value of the sale in front of the public national registry. If you do declare, okay, we're going to be selling this condo at $450,000 between our US buyer and Canadian seller, we submit the deed of sale to the National Registry with that $450,000 amount. The National Registry is going to look at the previous assessed value of that property, and if it's lower than the $450,000, you can bet that they are going to raise the assessed value in the registry and tack on there that the last sale price was $450,000. I think I have an example. If you are someone who can look at the National Registry, and if you understand Spanish, we're looking at the valor fiscal versus the valor de compra. So the registry contains data on both these numbers, which are essentially the tax assessed or fiscal or government price, and the most recent purchase price or valor de compra. That information here, what I've got, if you pull up a record in the National Registry, you'll see a property title with all of the relevant information, numbers that guide you to the land plat, whether it has a lien against it, who owns it, on and on, the information, the title of the property. This information is available if you're willing to set up a free account with the Registro Nacional, so it's 100% open to the public. Here I did a registry search on my own property to show you at least a little bit, up here, and actually a little bit is cut off. Some of the main information at the top of the page includes where it's located, what the legally neighboring properties are. Here's the information for the measurement, the registered land plat, and finally down here we've got, with these red arrows, you would find both the valor fiscal, or the government price or the assessed value of a property, and the estimación o precio, or the valor de compra, which is below the information for the owner of the property, and that shows you what the property's value was at the previous time of sale. Of course, remember, that number is based on the information provided to the National Registry when buyers and sellers complete their deed of sale. In calculating the capital gains tax, essentially the government is going to be taking only that number, the valor de compra, the purchase price, and using that as the calculation. And for a capital gains tax, as you might expect, what they're going to be doing is taking the current price, or the price that people want to sell at now, versus the registered valor de compra that is currently on the registry. And the difference between those numbers is the profit, your capital gain on the property, and that's what you're going to pay the tax on here in Costa Rica as of July 1st. Now remember this, so if you are currently purchasing property or about to close, it's very much in your interest to do so before actually June 28th, which is the last business day of the month, to avoid paying this, especially if you're selling your property. Now, what everybody is worried about here in Costa Rica is the fact that there are lots and lots of properties with a very low valor de compra because of that practice, like I mentioned earlier, where people are avoiding that initial transfer tax by submitting a lower sale price to the National Registry when they buy the property. Still exchanging a property, for example, at $450,000, but because those funds never come to Costa Rica and the government really has no way to know, the buyers and sellers might submit that at $200,000 to avoid the tax. Going forward, all of these values that are way too low in the National Registry present a risk to sellers who are now going to complete sales that might be an order of magnitude greater than that valor de compra that they had put in the last time they submitted a purchase contract when they personally got the property. I know personally we only had an unimproved lot at the time, and for a while the declared value on our property was very, very small until we built our house, etc. So if you're in the position of someone who owns a property that has one of these very low values and you're about to sell at a real world price that might be 10, 15 times as much, you should be very concerned about paying tax on that extreme difference between the old valor de compra and the new one. So let's get down to the details of how they're going to calculate the tax and ways that you won't necessarily be stuck in that situation of paying an absolutely enormous bill if you're purchasing or selling a property that has a low value registered that is only a fraction of the real cost for which you're going to sell it. If you're working with a property that is not generating income, a residence, just a property that you personally use for vacations, the tax is going to be 15% of the difference between that previous purchase value and the sale value today. 15%, it's a pretty simple, straightforward number. If you're able to prove that it is your primary residence and what you're really using as your home, the capital gains tax does not apply. It's still up in the air as to how the government is going to require people to prove that a place is their primary residential property in order to get an exemption from the tax. That information will be forthcoming, but I'm sure they will come up with some system involving a certified affidavit generated by a public notary stating that it's your primary residence. Who knows, you might have to show bills on and on, but it's to be determined. So that, in the case of a non-income generating property, you're looking at 15%. If you have an income generating property, a hotel, a business, even something you're just doing on Airbnb, you'll be looking to pay a 30% tax on the difference between that old purchase price and the one you're selling at today. So if you're earning $100,000, you purchased at $400,000, you're selling at $500,000, that $100,000 you would be looking to pay $30,000 in tax if it were a rental property that you're using as a business, and it's not your, obviously it wouldn't be your primary residence, but in these cases, commercial properties, rental properties, the amount will actually be calculated not necessarily over 100% of that difference. The example I gave was actually poor because on a 500 versus 400 sale, what you can also do, the government is allowing people to subtract 15% as a sort of standard deduction as sort of the operating expenses of that business, and that 15% can be removed from the total value of the property as the regular deduction, and you really only pay the difference on the tax on the difference between 85% of the total property value and the old purchase price. Again, that's going to be a 30% tax on the difference in those two numbers, but they do give you a 15% credit on the total value of the property for business expenses in the case of commercial properties. To sum up, really long story short, most properties 15% if you're occasionally using them as vacation homes, 30% on the capital gain for commercial properties. There is also an exception to the rule through which if you have a commercial property and you want to get more detailed about the deduction on the total value, if you have employees who are part of the registered Social Security programs, if you're clearly maintaining a business that is running with the law and has these expenses, there's another way for you to demonstrate an even higher level expense and get that tax reduced even further. I'm not personally familiar with all the nitty-gritty details, but it's something that you should definitely consult a lawyer about if you're about to buy or sell property here in Costa Rica. Again, my name is Matt Rosenstiel. If you had any questions about what I just talked about, feel free to email me at matt@cbtamarindo.com. Feel free to leave a question here in the comment section of the Facebook page, a question on the YouTube channel if that's where you're looking. To quickly sum up, today I gave a quick overview of the new capital gains tax. It's coming into effect on July 1st. I forgot to address a very significant exception in the rule I'm just now remembering. My apologies. This capital gains tax, there is one exception. Remember, we talked a lot about all of these properties that are super undervalued in the National Registry, oftentimes because people were trying to avoid taxes at the moment of transfer, or they simply haven't updated the value in the National Registry. If you're in that situation and you have a very low valued property and you're about to sell it for a real amount, the government is offering an opportunity, sort of an amnesty, to bring tax values up to where they should be, where instead of paying 15 or 30% on the difference, the capital gain that you have, you can pay a one-time fee of 2.5% of the total property value to adjust the value of the property in the registry. So let's say, in the case of my lot, it was originally assessed at $10,000 because it's a small property in a very quiet area, and that assessment stays on there until we're ready to sell. All of a sudden, I've built a home over the last 2 years, I've put in improvements, and my $10,000 lot is about to sell for $220,000 with a home, everything included, the chickens, the ducks. Contact me if you're interested. That difference between $220,000 and $10,000 or $210,000 is an enormous capital gain as far as the registry sees it. So, thank you very much, Carlos Dario Angulo. It is 2.25%. I very much appreciate that. So I stand corrected. The exception is 2.25. So let's say in this case I have an old registered value, $10,000. The new sale is happening at $220,000. I'm scared to death that paying 15% on $210,000, that's over $30,000 in taxes that I have to pay for the capital gain. Instead, through this program, only one time can you adjust the property of the value of the property in the National Registry, bring it all the way up to reality, and pay just 2.25% of the total value. In a lot of situations, for example, the one I just spoke of, a 2.25% on $220,000 to bring up the value is only going to be about $4,000 or $5,000, whereas the capital gain tax would have been over $30,000. So they are trying to work with people in these situations where the properties are super undervalued according to the valor de compra. You will have an opportunity to escape paying an absolutely massive capital gains tax. Finally, to touch on one point, sorry I gave sort of a false start on ending the video. To make one more point, what does this mean for you as a potential buyer or seller of property in Costa Rica? First of all, understand the registered value of your property and the sale value as well, the valor de compra. Find your property in the National Registry and see where you stand today so that you understand exactly where your valor de compra is going to go if and when you sell your property down the road. If you're buying property, it's a great time to make offers to sellers if you're perhaps able to close quickly before July 1st. It might be a great time to say to some people, you know, I've got cash, I'm a real buyer, I'm fast to go, I'm ready to go here. If we can close this sale, you're not going to pay the capital gains tax. And that might be an incentive for people right now to make deals, come down on their asking price, and do a sale with you sooner rather than later to avoid this issue. Once you know the value of your property and looking at the potential sale price, you will only be able to do that adjustment at 2.25% of the total value one time. So take care if you decide to do that in bringing up the value somewhere to a good price that is going to leave you not as exposed to a capital gains tax down the road. You can also simply wait until you're going to sell the property and see which of those numbers, either the 15 or 30% capital gains tax or the 2.25 exception tax, is going to work better financially for you. Because that exception doesn't necessarily expire on July 1st with the new tax law coming into effect. Rather, you will still be able to take advantage of it. Anyhow, that was my quick chat on the new capital gains tax. Again, feel free to send me emails, matt@cbtamarindo.com, if there's anything I can help you with. Feel free to send me a message. Carlos Dario has another saving on legal fees. Absolutely. Another important implication of the tax law, thanks again, Don Carlos. The 13% value-added tax in Costa Rica that applies to almost everything is now going to apply to everything, to be very short and sweet about the rest of the fiscal reform. So this capital gains tax is one component of the new tax reform. Value-added tax was also another component, and that was another pretty contentious issue. So if you close now before July 1st, you're going to avoid that 13% being added to the legal fees for your closing. In previous episodes, I've talked about those legal fees, which usually the public notary fee will either be 1.25, usually 1.5% of the total transfer cost. So there's all kinds of reasons to try and close on properties before July 1st if you're able to do so. And let me check, I've got a little bit more information here from Carl. Yep, absolutely, Don Carlos. Thank you very much for your comments and for joining us today. Thank you everybody for joining us. Feel free to send me questions with any follow-up. I also highly recommend you contact your attorney, your Costa Rican accountant, to fully understand the implications of the tax law. But I hope you've enjoyed this quick broadcast of Live from Costa Rica. Quick shout out to Brad Blake as well for joining us. And let's see. Yes, very much so. Brad, hope you're doing well, and I'm looking forward to seeing you when you're back down here. Thank you for joining me. Have a great day, and I look forward to seeing you all here soon in Costa Rica. Pura vida.